This is the Value Investor Podcast with Tracey Reineck. All things value, all the time.
Welcome back, value investors. So we've had a correction on the stock market. That means stocks have pulled back 10%. But then we've had some rallies, we've had some bouncing around, we've had some more sell-offs. It's unclear if we've seen the bottom in this correction, even though the Fed just cut 50 basis points and may be cutting again in later March. If you're listening to this later on in the year, you will know what they have done later in March. But for now, we've only got the 50 basis points. The good news for value investors is that stocks are cheap. The bad news is that Wall Street, of course, they still hate us. They still hate the value stocks. A lot of the rebound that's going on is going on in the bigger cap growth names. What was hot before is, of course, going to be hot again. And value was hated. When you get a sell-off, it's not like anyone's going to like it even more. No. So that's not good. And with the possibility of a global slowdown, though we don't know, the global economy is not yet in a recession. That could mean that oil is likely to weaken farther, even if OPEC does production cuts, because demand will fall in even a slowdown, but certainly in a global recession. And that means energy companies will struggle as oil comes down and demand comes down. There's just going to be less drilling, right? There's going to be less. And then airlines are already taking a big hit right now because everybody's suddenly putting the kibosh on travel. And even though they're cheap, earnings could slide or likely will slide. We haven't seen that many changes from the analysts in the estimates yet, but that is going to be coming down the pike. And I think some of the reasons we haven't seen a lot of earnings estimate revisions lower is because a lot of the companies are kind of just warning in the abstract sense. You know, we keep hearing, the coronavirus is going to materially impact our quarter. Well, what does that mean? No one knows. The companies themselves don't know, and the analysts certainly aren't going to try to figure it out and pin it down. So everybody's just kind of frozen where they are, knowing they're going to be cutting. But until the companies themselves come out with earnings and tell us or issue some kind of warning, then we may know. But even then, the companies are going on a day-to-day basis, basically. I did listen in on the Booking.com's conference call, and they basically said it was a fluid situation, and they were crunching the numbers on the day of the earnings call, even to give any kind of guidance for the rest of the quarter, which was only another 4 weeks. They only said they had any kind of insight possibly going through the end of March. And even that insight was basically no insight, is what they said. They tried to put into their guidance range possible scenarios that they've seen in the past and things that could happen if there's, further outbreaks in certain cities and how that might influence demand. But they even admitted that they were probably going to be wrong. So really, it is a day-to-day, and until we start seeing actual earnings reports from this quarter, which aren't going to be happening for a little while still, then nobody has any idea. So the analysts are just on the sidelines as well. Everybody believes earnings for this quarter, obviously, are going to drop. But how much, nobody knows. And what does second quarter look like? That's still up in the air as well. So turning back to other cheap areas, banks are cheap. They've been cheap for a while. I like the banks of all types, the community banks, the regionals, the big caps. But now that the Fed is cutting again, and some believe they're going to cut again after this 50 basis point, then that really goes to the bank earnings. Those estimates are going to be cut, and those shares have taken a hit on the Fed move. So a little bit difficult for them to try to grow their business here with what's happening with the Fed. If we have a recession, which is a big if, but even in a slowdown, the consumer stocks could get hit as well. Consumers could pull back on their purchases. We haven't seen much of that yet. Consumers been real confident because the job market's been good. But we don't know. We don't know what may develop. And so I recall after the 9/11 shock to the economy, the consumers were a little bit in shock themselves and basically retreated from buying a lot of things for at least a couple months after that event. And so this could be similar. We don't know. We're going to have to wait to see. So a lot of we don't knows. So what's an investor to do? Well, we could try to find some value stocks and some classic values. These would be the dirt cheap ones because remember, we've searched for classic values many times over the years, and it is the most complete of the screens I can do. And in even just a couple weeks ago, when the market was go, 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 we were only getting like 5 or 6 stocks in the classic value screen because everything was expensive then. And it has so many components to the screen that it's a very narrow screen. So we don't normally get many stocks in it. So let's recall what the screen is. Remember, it's Zacks number 1s and number 2s because we do want rising earnings estimates. And right now, a lot of companies still have the rising earnings estimates from their recent earnings reports and because the analysts have not been cutting, even though they probably will be. So right now, we're still getting 1s and 2s, and those are the buys and the strong buys. And then we added a whole bunch of the regular fundamentals to find value. So it includes a price to sales ratio under 1, which I love. Price to sales is a great fundamental to use to look for value, even unto itself. We could just run the screen with 1s and 2s and price to sales, and it would be pretty interesting. But we wanted more classic value fundamentals, and we wanted to narrow it, and we want dirt cheap in all these categories. So the second fundamental is price to book, and I used under 2 for that. Sometimes I use under 3. Either one would work for value. Then we did price to cash flow, and I did that under 20. And we included the PEG because we might as well get some growth with it, right? If we're going to be greedy and get all these classic fundamentals in there, I want to get some growth too. So if you have a PEG under 1, that usually means it's both cheap on the PE, but it has a decent growth rate. So that's what I want. And you can also actually use just the PE to screen, the PEG ratio. And we've done that too with the 1s and 2s. But again, we're including all of the ratios here. Then there's the PE, and this time I chose under 20, which is pretty high. Usually it's under 15, but went a little higher so we make sure we get some more stocks given how narrow the screen's going to be. Then I looked for stocks over $5. I know many of you like the under 5s, but we're trying to find something that maybe might not be as volatile here. And so we're going for the over 5s, and average volume has to be over 100,000 a day. So that might exclude some small caps that not many people are in. But again, that's okay in this type of market, which is really volatile and which still favors the large caps. I want to get a little bit bigger in the volume. I did not search for market cap on the screen. You could use that to get some of the larger caps as well. Okay, so how many stocks did I get on this? Like I said, I was getting 5 to 6 stocks in the past when we've run this screen. And this time I got 26. Yes, I was amazed. It's been a while since we had 26, but that tells you what's happened in this sell-off, right? Yes, we only went down around 10% in the major indexes, but some stocks were down into bear market territory. Even like a quarter of the S&P 500 was down 25% or more, or over 20% or more. So there's a lot to choose from that some might have pulled back and got cheaper under our classic value fundamentals. So what are they? There were some banks. I'm basically ignoring those for today's show. However, there's some airlines in there. There's a little bit of energy. There's a few retailers. It is the groups that we've been mainly talking about because everything else is not going to be cheap enough yet. A 10% pullback in the FANGs is not enough to get us a classic value stock. I know you all want it to be, but It takes a bigger pullback than 10% to get those guys into the real cheap range. They're cheaper, but not cheap. So what is in these 5 stocks? Let's just get right into it, right? Okay, so the first one is Lumber Liquidators, and that ticker is LL. I don't think I've talked about them for a while. They've had some issues over the last couple of years. They did have that PR issue on, I think it was 60 Minutes a couple of years ago with some of their flooring made in China. That really hit the shares, and they've been trying to recover ever since then. Plus, they're competing against some of the big box juggernauts like Home Depot and Lowe's for the flooring, which is still a hot area, but those things are all kind of leading to some of their issues. Now, this stock is off its lows. It's not one of the ones that has sold off in the last month. It's actually up 23%, probably off the last earnings report, which wasn't as bad as everybody thought it would be. But the stock is still cheap, has a PE of 11.4, price to sales is just 0.2, price to book 1.5, and a PEG ratio of 0.4. So Lumber Liquidator is kind of an interesting play on the retail side. If, Home Depot and Lowe's, a little too expensive, this one is maybe the underdog of the group. So Lumber Liquidators LL. Then switching to the airlines, I did include one here, and that's Delta. They made the screen. DAL is the ticker there. PE is just 6.3 right now. Price to sales 0.6, price to book 1.9, PEG is 0.45. Dividend is now yielding 3.4%. These shares are down 17% in the last month. The airlines, I don't know if this is the bottom, right? There's still a lot of cancellations going on. A lot of people are now canceling to Europe, not just Asia. There's a lot of pictures of empty planes. People are flying on my Twitter feed now where they're like, look, I'm the only one on this flight to Bangkok or wherever it is. And so that's not good. They are going to have a tough time of it here, but when will it turn? We don't for sure know yet. And Delta is also interesting. There was some insider buying last week on the big sell-off, the big correction week. There was a director who went in to buy, as well as Warren Buffett's Berkshire Hathaway. They have been shareholders for a while and are now a 10% owner. And they went in and bought another $45 million when those shares were selling off. So did he get the bottom? I don't know. Berkshire never cares if they actually get the bottom. They just try to buy when it's cheap, and they certainly have the cash to maybe buy multiple times. We don't know. So some insider buying at Delta, that's always a good sign. That means the insiders believe that the shares are oversold. And again, they have a PE of just 6.3. Another airline on the list is JetBlue. JBLU is the ticker there if you want to check that one out. All the airlines are cheap right now. So pick your poison, so to speak. Pick the one you know and like. And remember always to do your research about what's going on. Where do they fly to? Where is their exposure? Like Delta does not fly the 737 MAX. That's something good to know because that issue is still out there with the airlines as well. So yes, do your research again on all of these. The fundamentals don't tell you what's going on behind the scenes, remember. Okay, the third one is an energy stock. Berry Petroleum, BRY. I've talked about it before. It's a California E&P, and it has a pretty stable management that's been around a long time. So they're trying to manage this big sell-off. Shares are down 11.8% in the last month. They are one of the ones that pays a big dividend, yielding 7.6% right now. That's bigger than I can recall because these shares are really cheap. PE is at 3.9. The price to sales is 0.8, price to book is 0.5, and the PEG is 0.3. So Berry is cheap. There have been some issues about shale drilling in California that's been on the budget or on the ballot box a couple times, and so that's something to watch with this company. I think they've released some press releases about it. So do your homework on any energy company right now. Definitely check the book. make sure they are stable financially because we don't know where crude is going here. And so you want someone who has strong financials. So keep that in mind. Okay, our fourth company is another retailer. I haven't talked about them in a while. G3 Apparel Group, ticker GIII. And they don't get a lot of play, even though they have some of the biggest brands in apparel, including they do some stuff for Tommy Hilfiger, which is owned by PVH, but they license out to G3 because they're great at doing apparel. Basically, they know what they're doing. They also have some Calvin Klein and a lot of other brands, that are carried at, say, Macy's. They have some of their own retail, but they've been closing some of that as they've just really been struggling at like the outlet stores. So like Wilson's Leather, I'm not sure if they even just sold that off or are closing. I'm not sure on that chain, but they have a couple others, but some that they're not selling, like Villebrequin, that's still out there. That's like upscale swimwear, if you've seen their stores in North America and in Europe. So G3 Apparel is everywhere, but they do have big China exposure, even through manufacturing. So that's something that none of us seem to know what's going on. That's a caution here with them because they haven't reported earnings yet. So we don't know how the shutdowns from coronavirus on any kind of factories over in China, if they have that, is impacting. And so that made me nervous. I was a longtime shareholder of G3 and I have recently sold out of my position. So, but the shares are dirt cheap. I don't deny it. They're down 24% in the last month alone. Not quite at those 52-week or like multi-year lows, but they're eyeing it. Price to sales is just 0.3. Their PE is at 6.8 now. Price to book is 0.8. PEG is 0.6. Great management who's been around for a long time. They got great designers on their staff who know what the trends are. So I trust in their management, but sometimes trends go against you or, what's happening out there. The coronavirus, obviously, no one could predict that. And no one could predict, shutdown of stores in China as well. So PVH is also another one I like as well. Great company as well. That one's ticker PVH. They haven't reported yet either. They will move in tandem. So those shares are down big. They did not make the screen. They might not have the right rank right now, but that's another one I'm watching. Keep on your wish list if they get even cheaper, because some of these may. And then our fifth stock is one of the home builders. I've covered them off and on. They remain cheap. Some of them have pulled back off the recent highs, getting a rebound here now that the Fed has cut rates and the mortgage rates are at all-time lows. Will buyers be rushing out to buy a new house to cash in on these super low mortgage rates? Some people think yes. That's really going to boost the spring buying season. No one knows what coronavirus is going to impact, if anything, on if you're going to go out and buy. And then there's also always consumer confidence. How is that being impacted? We don't know. KB Home, KBH, is down just 2.4% now over the last month. So it fell a bit. It's rebounding here, but it is still cheap. PE of 9.4, price to sales of 0.7, price to book 1.3, PEG of 0.9, pays a small dividend, yielding 1% here. A couple others who made the list on the home builder side, TRI Point, which is TPH, is the ticker. They're trading around 10 times. And MDC Holding, which is ticker MDC, trading around 9.4 times. Both of those are off a little bit more off their highs than KB Home is, but they're all not currently at their all-time highs or like 5-year highs that they were at recently. So yes, it's kind of an eclectic list, isn't it? It is in the areas that are value that people love to hate. And I know many of you are like, yes, we know all these, Tracey. We know of the airlines and retailers and, home builders, but as they go cheaper, they get even a little, more attractive to us as value investors as they're being thrown out with the baby with the bathwater, right? We're going to panic and sell everything, then we're also going to sell the cheapest stocks. And the cheaper you get it, the better it is for us when there is a rebound. And think about what you're paying for those earnings. In some cases, I mean, we're paying just 3 times the earnings for Berry Petroleum there, or, 7 times the earnings for G3 Apparel. So some of these dirt cheap. So let me recap the tickers again. We had Lumber Liquidators, LL. Delta is DAL. We had Berry Petroleum, BRY, G3 Apparel, which is GIII, and then KB Homes, KBH. And we'll see what happens with these value stocks, or if they go even lower, some more value opportunities. And maybe we'll start to see a few of those tech names. Probably not the FANG, like I said, starting to inch in there, but we may see some semiconductors or some other interesting groups. Again, it does depend on the Zacks rank, and we got to have those 1 or 2 rank stocks. So if those estimates are being cut, we're not going to see them on this list. But, I'm keeping an eye out, and I'll be doing some shows in the next couple of weeks on the value traps again to see what is cheap with a good Zacks rank. That might be the trap, might not be the value. I did not look for trappiness on these 5 stocks, so you might want to check into that as well. But with the Zacks 1s or 2s, at least we're getting rising earnings estimates here, or at least something good is happening with them. But we may not be getting year-over-year earnings growth. That's 2 different things, remember. So the Zacks rank determined by analysts' estimate revisions, and what they are doing, whether or not they're cutting or raising, determines the rank. So keep that in mind when you're checking out all these stocks. And of course, I'll be back again next week with more value, so you don't want to miss a single episode. Subscribe on Spotify. We're on Apple Podcasts, and you get 2 episodes for 1 where I'm covering a lot of stocks on the Market Edge right now as well, and ones that are deals. So some value investors might want to check out the Zacks Market Edge podcast. Stuff is going on there as well. That's on SoundCloud, but don't miss a single episode, and I'll see you again next week with some more value stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.